All right. It's 10 a.m. and we are going to start our webinar here, how to get a mortgage in today's market. I am very excited about this because I have been getting a ton of emails, calls, texts from people asking, that people that want to get a single family residence or a second home or an investment property because they think that some big price adjustment is going to happen. They think that, or there's going to be a crash. But even if those things don't happen, we have historically low interest rates.
We do.
Guys, I'm joined, as you probably saw by the, advertisement that got you here, by the wonderful Lyndi Mallory, VP of Mortgage Lending at Guaranteed Rate. I've known Lyndi since the beginning of me getting into the business, which is almost a decade now.
We're crazy, right?
And I've referred her a ton of clients that have all given her rave reviews because of her natural patience, her temperament, her knowledge, her ability to flex when she needs to on the underwriters in a tactful and tactical way. Her ability just to always get to the finish line. She's never been one of those lenders that says, we're sorry, we don't know what to do, we can't. She just says, we got it there. So Lyndi, welcome and thank you.
Thank you. Thanks for having me. I'm very excited to be here.
I know, I was just telling Lyndi while we just started here, I was like, I haven't seen her face to face in a minute. It's been like
a while.
But so happy you're here. Maybe just to kind of give everyone maybe a small background on you to, aside from me.
Yeah, thank you. That's much better than I could do. My name is Lyndi Mallory. I work for Guaranteed Rate, which is one of the largest lenders in the country. The name of our game is like low rates, low fees. But I myself, yes, I've been doing this. It's all I've ever done. It's like embarrassing to say how long now, like 2 decades I've been doing mortgages. It's all I know.
You start when you were 14.
Yeah, it goes way back. I don't want to say my age. Yeah, I'm really young. It's been a long run, and I've had when you've been in the business that long, we've closed just about every escrow, every scenario, every story. We've seen it all. So it does help, that experience, to help push files through and kind of know what we're up against. And I understand what it feels like for the buyer to be coming into this new world. It's almost like we speak a foreign language sometimes, this whole mortgage real estate world. So I try to really hold everyone's hand and walk them through and ease them into this new experience they're about to jump into.
Yeah, I heard Tom Ferry once say, what are you good at that you do only, you do once every 10 years? So it's so important that we don't forget in the speed of things to hold everyone's hand, no matter how many times they've done it. Because even though we've seen, let's say in your case, probably tens of thousands of files, I've touched 300 transactions in my career. We forget that some of the verbiage and stuff that we use, people have no idea what we're talking about. But anyway, moving forward into this, I don't want to forget our first time buyers. So I may stop you at some points just to say, hey, what does that mean? So speaking of which, what is the difference between what you do as a mortgage broker versus someone that's, let's say, a loan officer at someone's commercial bank, like someone banks at Bank of America? What's the difference?
Yeah, that's a really great question. The difference is I have access to kind of everything. So we are a direct lender. So I'm direct with Freddie, Fannie, and then we're also direct with the big names. We have everything. We've got Wells under our umbrella, but we underwrite it ourselves. So you notice probably the hand holding and the extra time I have because my system is so smooth and our systems are much faster than the banks are. So mostly the difference is I have access to everything. Sometimes though, like my husband is at a big bank, so I really do know the difference between what I'm doing at my company where I have access to all of these options. Most of them are direct. I can broker, which is nice because there are going to be some instances where someone might need to use all bank statements to qualify for a loan, and a bank would never do that. I've got that option. So I've got the regular stuff, I've got some funky stuff, but sometimes the bank will come in if a client has more funds in their bank account, a bank might have a lower interest rate. So the difference is really just, I think, the amount of options I have. We can really pull something from somewhere and put it someplace else if needed.
Yeah, so if I can tag on to that as base into my experience with the right mortgage broker, someone like Lyndi, it's the difference between, let's say, you want to go stay at a hotel. You can stay at the Quality Inn and potentially get the lowest possible rate possible. However, you can also stay at the Ritz-Carlton and get a different kind of service experience where you're not pulling your hair out. The other thing is it's Lyndi's job to know what all of the banks are doing. Whereas if you just go to the bank where you have all your money, they just know how to service you within their own protocol, within their own rules. And what's important to understand is that different, every business out there, you could have one real estate agent like me who is in the volume game and wants to do everything under $1 million. Then you could have other agents where they want to do, let's say they'll only take a listing from 10 million and up. So everyone has different business models. And it's the same thing with the banks. They have different tolerances, despite some of the federal guidelines they have to adhere to with the secondary market, but they do have different tolerances, different underwriting standards. So someone like Lyndi or a mortgage broker can kind of look at your profile and go, you know what, based on what you want, what you need, and what these banks require, this is who I'm gonna put you with. So they can act as a great matchmaker too.
Exactly.
So moving forward, for the first-time buyers, what do you think are the most important criteria points? Like if someone says, I want to get pre-approved, what am I going to have to send over? And also, what is important that I have in tip-top shape?
Yes. So basically income is, I would say, number one, and especially in this moment that we're experiencing in time, this situation, the current market, income is actually more important than anything right now.
Wow.
So, before I might have answered that question, income, assets, but income is where they're really focusing because of the situation. You're not allowed to be furloughed. If you're self-employed, it's a little more, there's a little more to it than there was prior to this. But in general, income, you really want, pre-approvals are so simple now. I think it's really come a long way with our system is so digital friendly. It's really a couple of paycheck stubs if you're employed, a couple of paycheck stubs, a couple of W-2s, a couple of bank statements, and an online application, and boom, you can be pre-approved. So it is.
Before people to show income, they were showing the last few years of the tax returns. Now they're having to show a couple checks.
Yeah, exactly. Yep. If they're employed, it's become much easier. It used to be you have to have those 2 years tax returns. You have to go dig those up. Now, if you're a W-2'd employed borrower, you simply need 2 years of W-2s and a couple of paycheck stubs. You don't even have to provide tax returns anymore. So it's pretty easy in terms of paperwork to get pre-approved. Self-employed is going to be a little more in depth. You're going to have 2 years of tax returns. There are cases where I can get away with 1 year. Being that I'm not at a bank, that is one capability we have. We could do a 1 year tax return, which sometimes
that's a big one, guys, by the way.
Yeah, because when you have to average in, if you're looking at 18 and 19 and you have to average those years, if 18 was much lower, you're going to be at a disadvantage. Where if we pulled out at one of our 1 year tax return programs, you'd be able to qualify for much more. So that can come in handy. But yeah, it's
so income important. Of course, credit is important. Their credit score
is important too.
Right.
I can always help advise on that. I just pulled credit a few minutes ago for a client who had a small collection that she couldn't believe was on her credit, but I told her exactly what to do to get it removed. So that's something I can always help with. But yes, credit. And if you don't know, don't worry. It's better to have someone like me take a look and tell you, hey, it looks great. Or, you know what, there's this thing that popped up we can get rid of pretty easily. We could have that gone within 30, 60 days, sometimes a week. So I always say it's better to just take a look because you don't know, and don't be afraid to see what's on your credit. We can tackle it. We can get rid of something we don't like. But yeah, so credit score is important.
Hmm.
Um,
And then reserves, of course, right? How
and
much
then
money you have
lastly,
saved.
reserves. Exactly. The money you have left over in your account after your down payment.
Hmm.
Um, that one varies a lot from program to program. I think that will change even more in the coming year after what's happened. But currently, assets, reserves aren't that high. I mean, Freddie and Fannie require nothing.
So
So,
guys, just FYI, Freddie and Fannie, and we could do an entire other webinar on Freddie and Fannie, but effectively banks give loans. They're required by the federal government to keep a certain amount of cash on hand. Once they give you a loan, they now have less cash on hand. So they have to sell it to the secondary market. Those secondary markets have rules. So the banks can't just give anyone a loan for them to buy it. Once they buy it, the cash then goes back to the banks. They have a higher reserve on they have a higher reserve of cash, and then they can keep giving more loans. So anytime I hope that was the quick bulleted version. Anytime Lyndi refers to Freddie and Fannie, they often dictate the parameters with which the big banks can give loans. Now, there are groups out there that are anxious to just loan their money, so they have looser restrictions, but then the interest rates go up. The interest rates definitely go up as the banks, or any lender for that matter, see your risk profile. That risk profile is dictated by how much you put down, your income, your credit score, your past tax returns to show earnings over time, and of course, how much money you're going to have in the bank. They don't want you, putting your entire life savings down, then there's a rainy day and then they get stuck with the house. The last thing the banks want is to get stuck with the house. They're not real estate agents. They are not real estate investment trusts. They usually take a loss. And the last thing they want to get stuck with is the house. So they use these criteria points. Now, so with that said, Lyndi, question for you. When should a buyer get pre-approved? When?
right away. Right away.
Why right away?
The minute they're thinking about it, there's no harm in it. So many people think, oh, I'm going to wait. Maybe when I have a few more dollars saved, or maybe I'll work on my credit on my own a little bit. Just apply right away. There's no harm. It's not like, I think a lot of times people think, oh, maybe I apply and my credit score or my bank account figure isn't exactly where I want it. That's okay. It's not a denial situation. It's, we look at the file, and then together we can say, hey, you know what, if your bank account gets to this point, we'll give you the letter. Or if your credit score, why don't you work on getting this old collection deleted, and in a couple weeks we can give you the letter. But you're done. You don't have to reapply once you've applied, at least with my company. I can't really speak to others on that front, but with us, if you apply and there's things that need to be tweaked or things we need to work on, we can simply update that application months from now. So there's no harm in checking out what you can do. And in these times, now it's really a requirement to have a pre-approval letter to go look at something.
Well, from my point of view, and I'm going to ask you the question that everyone always asks me, and I frankly don't know the answer, and I think it's because it varies from bank to bank. But in my experience, it tells you where you should be looking on price. I have had people before, very close friends of mine, so I didn't really push them to get pre-approved first. And they're like, I'm getting pre-approved with my father. We own several properties. The loans are all with this big bank. And they're like, we're comfortable in this price range. We looked and looked and looked and looked. We found something. We got an escrow. And by, on the third week, they just couldn't get the loan from the bank. And then when we tried to adapt, the seller was not impatient. They ended up moving to the backup offer and canceled. And what we ended up having to do was we had to adjust down to, the next price category down. And let me tell you, as a home buyer, the worst feeling in the world, aside from wasting all of this time and emotions on looking at all these places and then being forced to go down in price and nothing looks anywhere near the stuff from before, it's nearly an impossible task to overcome. Personally, I mean, imagine thinking like, okay, I can afford this car, and then finding out you really can only afford like, $15,000 less car, $20,000 less, when you had your heart set on, you could see yourself driving, how your life was going to change.
Totally.
So the pre-approval process, aside from that, is also important because, especially in our state, probably in any state, the seller has all the leverage until we open escrow. And then once the escrow opens based on the contract language, especially in California, all of the leverage goes to the buyer. Effectively, not effectively, by contract, the seller cannot cancel unless the buyer does not perform. So the buyer can basically force them to sell. So because of that, sellers are super picky who they decide to get into escrow with because they're contractually tied to them. So it is incumbent upon buyers to, it's like dating. They have to court the seller. And one of the most important parts of that, more than price and terms, is demonstrating a financial wherewithal to get to the finish line. Because if a seller ends up having to cancel the escrow, they have all the risk. People say, oh, back on market on Zillow, there must be something wrong with it. When in fact, they just accepted an escrow with a buyer who couldn't perform from the beginning. So it's so important. And that pre-approval letter from a reputable lender is an important part of that. So here's the question that I was going to ask you. How long does the pre-approval last?
Yes, everybody wants to know. It's technically, like what I should say is 90 days. But we don't make anyone reapply. So that's another reason I just encourage, just go ahead and do it, because many times, especially in our market, you have to shop for a while, or, you know, there are multiple offers out there. It can take a little time, or, you know, finding that perfect place takes some time. So you may start this process now, and I get calls. Let's say I do an application for someone today. They're going to call me in December and go, we found it. We found the house. We love it. What do we do? It's very easy for me. I don't make them reapply. I simply say, send me a couple of those recent paycheck stubs. The ones I have are too old. Let me make sure the salary is the same. So it's a much faster process. And I can shoot out that letter, and you've seen it before, 10 minutes. You know, it's like, okay, I'll talk to the client. Are things still the same? Great. I'll give you a new letter. So in my case, you don't have to redo an application. I'm not sure about the compliance with each other lender out there or bank, but for us, it makes sense to do it now because there's just no harm in it.
Sure. So I just want to put out there, I probably should have said this in the beginning, guys, for those of you watching, there is a little Q&A button down at the bottom. If you have questions, please, please, please feel free to put them in there, and we'll try to get to them at the end. We've left some time for Q&A, and we will certainly get to those questions, I promise you. So, okay, let's move on. Oh, we already have a question. Amazing. Thank you. We're going to answer it. I promise you. So moving on to, well, just one side tip. We already talked about criteria. So if you want to dive in specifically on any item, you can, but this question that I have for you is more of an overall. Okay, I'll give an example. In the past, to get the best rates, in my experience, kind of the magic number on credit was 740. If you were above 740, you were getting the best of the best, as far as I know. Now, by the way, that excludes if you have $1 million with Fidelity, or I should say, like Morgan Stanley. They're not in the business of home loans. They're not advertising there, but so people aren't wooed away by other banks. They'll give like crazy rates, but generally speaking, 740 or so. And also, generally speaking, I know that the banks liked a 45% debt to income ratio. And for those of you that don't know what I'm talking about at home, specifically, I mean, they look at all of your debts on your credit report and they go, okay, at the end of the day, your mortgage, your interest, your tax, your insurance, and all the other debt you owe versus the income you make, we're not going to be okay with you having, more than 45% debt to your income, because you still need food. You still need, to go to the club on Saturday.
We all have needs.
So my long-winded version of this question is, and reserves overall, have these become, let's just make it much tougher? Has it, or, because I know the banks are a little risk averse, moderately tougher, or would you say a little tougher?
Great question. And luckily, not much tougher right now in terms of reserves. I feel like, okay, so we've seen some things change. Credit score has, for the most part, remained the same for me. We haven't had an increase in need for credit score. It's kind of what you said, 740, 760, depending on the loan program. you're gold. You're getting the
Now,
best
wait,
rate.
by the way, guys, it doesn't mean you can't get a loan if you don't have that. I'm just
Correct.
talking about like best possible.
Yes, if you want that,
You can get a loan in the
299 on,
600s.
yeah.
But
You
just
want,
to manage expectations, when you call someone and say, I saw this, advertisement for this much, that's for, in the small print, it says for like prime candidates. So
exactly.
this is part of it. Sorry to interrupt you.
But you're right. It doesn't mean that you have a lower score that you can't get a great rate. Rates are great across the board. So true. If you in your mind think, oh my gosh, I've got a 690, I'm toast. That's not the case. Yeah. In fact, FHA, you can be in the low threes have a 660 credit score and still have a killer interest rate. So it doesn't mean you're out. But yeah, if you're out shopping for the best rate, usually a 740, 760, depending on the program. Reserves, meaning the money you have left over after the down payment, I expect that to get worse. My prediction is that will be something we see that may get tougher in the future. The reason for that, I think, is in this environment, as you know, at the beginning, it was said that you could defer your mortgage payment. And a lot of people rushed out to defer mortgage payments. Well, there's going to be an assessment, the banks are going to go, wait a minute, we had this many people not pay payments for 3 months. We need to make sure these people who are going in and getting mortgages have more money in the bank. That hasn't really happened across the board yet, though.
Wow.
My husband is at Citibank, so we're kind of a one-stop shop here. I've got a lot of different programs I can talk about, but he's got 15% down with 50,000 in reserves needed. That's it. Which, in our market might be 6 months of payments, 6 to 9 months of payments in reserves.
Is there a limit on the loan amount? Is that jumbo or
up to 2 million? He's going up to 2 million with 2 million financed with 15% down.
And how much in reserves?
50,000 left over in reserves.
Oh my God, I may call him.
It's incredible. He's the only one in town
I'm on the
that has
hunt,
that.
everyone, by the way, for a new house, and also specifically, just for what it's worth, because I know people like us in sales to kind of put up or shut up.
Yeah.
I'm on the hunt, and certainly in secondary market, because if things start getting tight for certain people, the first thing that goes is that, that second residence. So there's, real estate lags a little bit. So we're not seeing anything crazy. But in fact, between me and, who I call my right hand, we had 20 showings last Saturday.
Incredible.
So I think, real estate does lag a little bit, and our market is, a very unique place, being that everyone still live in sunny Los Angeles. But, that's those second homes, they tend to kind of be the first thing we do this with. So it's a good thing to kind of look at. But that sounds really good. Anyway, sorry, as you were saying.
So far, so good. Yeah, I mean, we haven't seen any brutal changes aside from currently earning income. That's the one that Freddie and Fannie, which we talked about earlier, Freddie and Fannie kind of set the tone with the guidelines. And so most of the big banks have come to this too, where if you're furloughed or, you still get pre-approved, because as soon as you're back on the job, you're good. So
okay, what about someone, let's just say, like that's in entertainment, that maybe their show is currently on pause because they're not shooting, or let's say like someone like me, because there's lots of people that are in a similar business as I am. They're like a commission-based salesperson, where like I'm incorporated, and then what happens? You start looking at bank statements for commission checks to have come in.
It's coming to that. Yes.
Wow.
It started out. Yeah. They're really digging in. The most important thing. And I think that's the government kind of going, we don't want the mortgage companies, the mortgage business to have any part of this getting any worse, or, so they're really making sure that if someone is going in to get a mortgage, that they are currently earning income. So that's the only thing that I've really seen change. I do think though, reserve requirements are to come. I really think for the end of the year, we'll see banks go, we're going to kick that up another 3 months of reserves for that product. I still have 10% down with only 9 months reserves.
Okay, that's a brilliant segue. So I was actually just going to suggest we move into loan products. Now, for first-time buyers, let's just quickly talk about this.
Yes.
Our parents all were in like a different world. And basically, all they did was just get 30-year fixed. They're like, I need to get the rate. I'm going to lock it in. And it's going to be locked in And we're
I'm
locking it
not
in.
moving. I'm not going anywhere for 30
We're
years.
locking the rate for 30 years. But
Yeah.
like statistically, you're moving in 7. And
Mm-hmm.
in my market, specifically in the Hollywood Hills, you're moving in like 4.
Right.
So with that said, I think it's important for people to understand that just like Apple or BMW offer an array of products for people's lifestyles, so do banks. And then their mortgage rates are adjusted based on what they're offering you. Someone like me, just to give an example, I know that the next home I buy, I'm going to probably move in 7 years or sell it, more than likely, because I know what type of property I'm going to buy. So I'm going to look at, when I look at the things that make up my monthly payment, the principal, which is the piece of the loan amount I'm paying back, the interest, which is the small fee the bank is paying me to rent the money, my taxes, which the state is going to be taking, my property taxes, and my insurance, just to make sure if anything goes wrong, the property's insured. I'm going to look at how much of that is tax deductible. Because if a large portion of it is not tax deductible, why am I paying into the loan amount if I'm going to sell the property in 7 years anyway? And by the way, we could do another webinar on, but when you have a fully amortized loan, it's such a small piece of the loan principal in the beginning you're paying back anyway. The bank's taking fees. So with that, with principal not being something you can deduct, why are you locking in for 30 years when you could potentially get a lower interest rate and only pay interest for 10 or 10 years, let's say, when you know you're going to move? And I will say, in the history of me asking lenders this question, if you were going to get a loan today, what would you get? 100% of them said interest only. Now, maybe because most of them lived in California.
Yeah, I'm on an interest only myself.
Okay, so there you go. So with that said, when you hear Lyndi say 10% or 15%, she's talking about the down payment. So historically, people always thought that they had to put 20% down. So if you buy $1 million house, you have to put $250,000 down, because the bank thinks if they've got 20%, they're in a lower risk category. We'll give them the loan for the $750,000, and we'll charge them a small amount of money each month to rent that money. So with that, you were just saying that you have 15%. So are there, I guess my question for you is are there loan products that have been phased out or basically kind of near impossible to get because the requirements are silly, which would make sense. The banks are allowed to pump the brakes here and there. Actually, we want them to be conservative because our gross domestic product and economy can be greatly affected by the housing market. And are there any that you think it would be something that you would lean towards recommending right now?
Yes. To answer your question, yes, some have been phased out because of the current market. They're typically the loans that the banks see as a little bit riskier to themselves. It's not riskier for the client. It's the bank looking out for their own risk.
So what does that mean? Like the lower down payments?
Yeah, well, exactly. So the lower down payments, you've got less skin in the game. You as a buyer, as a homeowner, easier for you to walk away. It's all, like you said earlier, the banks don't want to own a home, despite what they don't want. The banks don't want your house. They want you to be able to continue to pay for it. So they underwrite accordingly. And when you put less money down, you are riskier to them because they think you can walk away easier. It's all about avoiding foreclosure. Interest only has become a little more strict during this time because, again, the bank is interest only is considered riskier for them to lend to. It's riskier for them to give out an interest only loan because you as the buyer, we may look at it and go, I'm doing an interest only and I'm investing the difference on the side. I'm putting that monthly amount that would go to principal. I've got a separate savings that I think is better than putting it into a mortgage where it's just sitting. So I invest and save that money on the side. The bank assumes the worst. They're assuming that person's not going to do that. They're assuming they're spending every penny and taking the lowest monthly mortgage payment. So interest only is considered riskier for them to lend. So we were able to do 10% down on interest only for many years, but now we can't. If you're doing interest only, you need 20% down. You can still do it with 20% down, which a lot of companies are Mike at Citi, my husband, they can do 20% down, interest only still.
Mm-hmm.
Many of the banks, I can say, I've got a best friend over at B of A, a best buddy at Wells. So we speak often during these times and kind of updating each other on what's happening. I know B of A on jumbo is straight 30% down right now, just 30 across the board.
Wait, that's on
purchases, jumbo purchases.
So wait, does that mean any down payment?
Yes, they're basically trying to not
Does that mean any like if it's adjustable rate or fixed? It's 30% down.
30% across the board. They are just trying to stop the flow of loan volume.
Well, wait a minute. In exchange for 30% down, are their rates incredibly low?
They're good. But
oh my God, you said they're good, not great.
They're great. I mean, they're as good as. All I can compare them to is Mike is at Citi still doing 15% down at the same rates. So they've just really stepped back. It's truly just
now we're getting into the meat of this thing. We're really getting into the meat of
they are stepping out. Yeah.
That's crazy.
And the reason though, really though, isn't so much the illness that's going around right now. It's what happened at the beginning of this was a drop in the stock market that caused interest rates to bottom out. So we had the biggest refinance boom. I mean, it was crazy.
Yeah.
These banks got flooded. All of us were just flooded at the beginning of what went down. And then the stay-at-home order happened. All of these companies had to move record amounts of business, all of their employees from offices to their homes. So a lot of banks, a lot of these guidelines aren't necessarily risk because of the illness. It's because they're just flooded. They're overwhelmed. They need to catch up. So I think that's the case, honestly, with B of A. I think it's let's do 30% down. Let's stop the flow, catch up, catch our breath. So rates are still amazing. Wells Fargo, they cut out investment properties. You can't purchase an investment with them. They will not allow financing on investment properties currently.
So does that mean if I want to buy a place in Palm Springs, I can't get a loan with Wells Fargo if it's my non-primary residence?
Exactly. Right now.
Wow.
So they, again, same thing, stopping the flow. Refinances are the craziest thing, I think, with Wells. My very dear friend is there and he's a little frustrated during these, we've got these awesome interest rates. To do refinances, clients have to have $250,000 in the bank. So you are seeing definitely across the board, it's almost not so much like risk. I think most of these changes are really just for the banks to catch up, catch their breath.
Well, here's what I think that kind of frankly sucks, because there are lots of people out there like me that have been stacking cash, let's say, and waiting for a buy low moment. And then the moment this moment comes where, because generally speaking, we see affordability of housing get better, certainly in pedigreed, metropolitan areas, and then the subsections thereof. When there's some perceived problem that's causing a lack of confidence. So it gives people the opportunity to go in and maybe get a little bit more for less when they've been, scratching their head for an entire cycle going, man, everything costs so much. And then, the banks kind of hit the brakes, unless, you're uber wealthy and can just make a cash purchase. So I think that's a little disappointing, but that doesn't mean it's not navigable. I want to go back to one thing. So earlier on, we talked about debt to income ratio. So I want to make sure that everyone understands this. Like I said, right, historically, banks didn't want to see around, let's just call it mid 40% debt to your monthly income. The other reason why people will go towards interest only is because Lyndi mentioned it brings down your monthly payment.
Yes.
So what that does is it gives you more room to buy something, let's say for a higher price, because your monthly, let's just call it your monthly nut, your monthly mortgage payment is lower. So it still fits into the debt to income requirements. So that's why sometimes where we've had people come to us and they say, yes, we're pre-approved. And then they and the lenders say, look, we can only afford up to X. But once after we've been out seeing things for, let's say, 60 days, we learn that what they want actually costs more. So then we'll go back to the lender and say, is there any other product that we can move into that gives us more purchasing power. And by purchasing power, I mean by bringing down that monthly nut.
Yeah, and it gets tough because on interest only, again, the bank is always underwriting against you, and the bank is looking at an interest only as riskier. They will, it's tough that you actually, it's harder to qualify for an interest only.
Yes.
Sure. Because they're actually going to calculate that payment at higher than it is. So if it's interest only, they won't qualify you for that lower payment. They're going to qualify you for that payment as a principal and interest and a higher interest rate.
Yeah.
Because interest onlys are ARMs, adjustable rate mortgages, meaning that, you know, you're going to have it's, let's say, fixed for 5 years or fixed for 7, fixed for 10, and it's interest only. After that interest only period ends, if you do nothing about it, which is very easy to refinance ahead of time, but if you did nothing about it, it would become principal interest and it would adjust up. So they're underwriting for the future for you, assuming you don't do anything. You don't move, you don't refinance, which we know wouldn't be the case, but that's the way the bank looks at it.
So I will quickly paraphrase what Lyndi just said. Effectively, when you go to get, the banks don't love giving out interest only just because it's higher risk. But so what I would say to all of you out there watching, let's say you're like, I want to make a purchase between $1 million and $1.5 million. It may make more sense for you to just stick at 1 million because the bank will approve you at 1 million because they're not going, when they look at the DTI or the debt to income, while they're going to allow you to get the loan, the qualification standard's higher. They're still going to, they still want to make sure you have enough in reserves and enough in income to make the payment on what would have been a, like, let's say a 30-year fixed.
Right.
So if you end up going down in purchase price, you will get, and it'll be easier probably to get this interest only loan at the lower price. And then from there, you can use all the money that you're saving monthly to improve the property because the bank's not going to take a piece of your profits when you go to sell it. And then, or put the money to work in other ways that's maybe more tax deductible than, say, just putting money towards a principal. So that's something, it's a little bit more of a complex trajectory for what we're trying to cover today, but it's something either me or Lyndi could speak with you privately about. So the other thing that I would ask you is, could maybe elaborate a little bit more, if you could, on what you know on, like, a lot of my entertainment clients, they're strictly City National. They're just like, these guys, they cater to us. They understand that we have a non-traditional type of income flow. And not only do they cater towards our financial profile, they give us good rates. So it's a no-brainer. So I would say, because this really was important to me and presumably to those that are thinking about getting pre-approval now, what, you know, you touched on each bank. Do you want to, is there anything else you want to add? Like, if someone were to come to you now, standard W-2.
Yeah.
And they want to get pre-approved. What, you know, maybe you can't say this, but in the past, I have experienced a lot of people moving towards Union Bank of California because their rates were the lowest. But in exchange for that, these guys were grinders in underwriting. I mean, like, people pulling their hair out. So what would you say, like, if someone came to you now, or if you can't say this, let's say it's me, what would be the good trajectory? Like, who would you recommend is going to be a path of a little more ease?
Yeah, it really depends on the particular buyer and their profile. Here's what I can say. You know, we talked a lot about what restrictions have come about, or what
Sure.
challenges have come. Here I can say what the great news is, what we can do, which is pretty outstanding. Buyers can still buy up to about $800,000 purchase price with 3.5% down. That's still available, no reserves. You can purchase up to $1 million finance. What is that? You know, over 1.1 for your purchase price with 10% down, and still get a rate in the 3s. I suggest most people are doing 7-year ARMs on that.
And keep in mind, our parents were getting like 13%, loans
right?
at 13%.
Yes, it's crazy when you think about rates are incredible. So it is a great time. You can still get 10%. That still exists. So I've got the 10% down up to $1 million finance, very little reserves for 10% down. I know Mike over here has 15% down up to $2 million. We've got interest only loans with 20% down. It's an incredible time to get mortgage financing. And like you had mentioned though, with City National or Union, it really depends. I have a business manager I work with, and he works with myself and a person at City National. And there's some cases where it works better there. And a lot of cases, it'll work better with me. It really depends on that person and their situation. City National, a lot of those clients have a lot of money in the bank with them too, which gives some leeway that a lot of people may not have. So,
Just
yeah.
a quick aside, when Lyndi says with me, guaranteed rate also, she said it earlier, they're direct lenders. Some mortgage brokers are not in the loan business, but guaranteed rate also does loans. So that's why she's saying it'll work better with me. Sometimes, like I've had clients that I referred to Lyndi, and they were like, oh, you know, we're in the market because like we saw these low interest rates, and you know, we're ready to go now. This has now become, it seems like a good time. And then what will happen is she'll go, look, yes, that bank can give you that interest rate, but based on your financial profile, ultimately they could leave you at the altar once you're, you know, 2 weeks in. Whereas let's say guaranteed rate may not be able to match that rate, but we may be an eighth of a point higher, a quarter of a point higher. But I can tell you right now with 100% certainty, you're going to get the loan. And that alone, by the way, is worth the rate, whatever that small changes. And, you know, that could end up being like $100 a month or something like that. And trust me, my clients, they're, you know, when they sell their house for $250,000 profit, having not done much to it 3 years later, they are never coming back to me being like, that Lyndi, it was an eighth of a percent. They're like, thank you for introducing me to her, and thank you for helping me find this house. So anyway.
Yeah. And I can recognize too, you know, now with having my husband at City, it's nice if I have a client who comes in and they call and we do the whole conversation about purchasing, and I come to find out they've got $500,000 sitting in a bank account. You know what I do? I introduce them. I just say, listen, Mike's going to get you 3.1% on this $2 million loan because of the amount of money you have. So here, let's have you do that. So I really do look out for their best interests overall and can recommend the best possible financing option, even if it isn't myself.
Mm-hmm. And pre-approval, people should understand, it doesn't cost anything.
No, doesn't cost anything, and it's smooth and easy with me. That's for sure.
People sometimes will say to us, hey, I don't want it to ding my credit.
Good one. Yeah, I hear that constantly. And it's a valid concern. Where that comes from though, is from consumer credit pulls. So when people are getting a pull for a car loan or a credit card, you can go accumulate a lot of that in one day, and the credit reports, they nail you for it. And not terribly, but you know, you can lose 20 points because you had your credit pulled for a credit card. Car loan, you can lose 50 points in a day for car pulls. Mortgages are not treated that way. You will not see a change in your credit score, your mortgage FICO score. You won't see a change in that over a mortgage pull because you can't go accumulate a bunch of those in a day. So they don't ding you for it. So you really won't see an impact on the credit score.
You know what's crazy is I was playing golf over the weekend, and I was playing with this guy who's a commercial investor. And he said to me, the banks they've shut off loans. They're not loaning money. And like, it's just funny hearing from you, who's an actual lender, saying, well, no, that's not true at all. It's a great time to get a loan. The other thing that I thought was interesting that he said was a lot of commercial owners, retail spaces, they are exchanging those properties into, and by the way, guys, when I say exchange, I mean like they're deferring their tax liability when they sell. Into non-primary single-family residences and leasing them out because they're not sure where retail is going to go. So I wonder if that kind of move and how big it is will continue to add stability to our market. And the things that we're seeing, at least in Los Angeles, is that low interest rates are creating buyer urgency. Low inventory is also propping up prices or at least stabilizing them. We thought people were going to start to see like a 10% discount on every transaction. Some, yes. On the super high end, yes. But under 2 million, we're not seeing crazy discounts. If something's been on the market for I would say 120 days plus, yes, there's definitely an opportunity there. But anyway, I want to get to this one question we have. And guys, I encourage you, if you have any questions of the dozen of you that are on right now, if you have any questions, please put it in the Q&A button. We're going to start with the first one. So an anonymous attendee is asking, do retirement accounts count towards cash reserves?
They do. They do. Typically, it's 60 across the board. I would say in general, it's 60% of the amount you have in that account will count toward reserves. However, that 10% down program I mentioned to you earlier that I have, that particular investor will use 100% of your retirement as reserves. So
what?
Yes. So it's crazy. That's why these programs, they really vary so much from bank to bank and program to program. But that 10% down I have will use 100% retirement.
And that's for like up to the 1.1 purchase price.
Exactly. 1 million financed. Exactly.
So 1 million financed, 10% down. And so guys, in the past, sometimes banks will make you pay, they'll make you assume some of the risk by buying an insurance plan, which you pay a small premium for monthly, called private mortgage insurance, PMI, or sometimes NMI, I think it was called. Yep. Is there any insurance requirement for 10%?
Not on that program. There's no monthly mortgage insurance.
And what's the rate around?
I can tell you, I just priced this for another client. We priced up a 10-year ARM. So you're fixed for 10 years, 3.875 with no points. So you're still in the threes. So so they're still great. I have to say, I'm a little surprised. I thought that one would adjust. I thought they would go 15% down, or, we're not doing 10 anymore, or that they would bump up the reserve requirement. They didn't. So that's still available.
So for people in our market, we're kind of, I sell basically Los Feliz to the water, where generally the entry threshold for a house that is not in disaster condition, generally, let's just call it 1.3. Now we're over that 1.1 threshold. What can someone like that expect around?
They could do 15% down. 15% down, you'd need about 50,000 in reserves. And this is, I'm speaking to a city program, but Mike can do 15% down, 50,000 in reserves on that, and no monthly mortgage insurance, interest rate on that, like 3.25 on a 30-year fix.
And that's up to 2 million?
Yes. So that's
2 million loan amount.
Loan amount. Up
so
to 2 million
15%
finance.
down is 30,000. Oh, no. I think 30,000. I think it's 30,000.
Somewhere in there. Let me get my calculator.
On 2 million, I think it's 30,000. I think. Yeah. So
you can finance up to 2 million.
300,000.
Yes, right. So 300,000. 2.3 should be our price with 15% down, and that's a 30-year fixed in the low threes.
Oh, wow.
No PMI.
Now, what if someone's buying above 2 million?
Okay, then that's going to change the game. If you're above 2 million, I think Mike is at 20. Can you still do working at home? Hey, City, can you still do 20% down up to 3 million financed? 20% down up to 3 million.
Wow. And wait, what about the retirement funds? Are they still at 100?
No, that's going to be back to kind of normal. That's a kind of a strange little program that 10% down. It's a credit union we use for that. But no, back to that's sort of more on the normal, and that's going to be 60%.
So basically, what I'm hearing is there's some incredible programs for 2 million and below, and for those that are above 2 million, it's pretty much the same.
Yeah, I mean, some banks have changed. B of A changed. They're at 40% down right now on those loans above 2 million. it's just the moment in time, I think. But yeah, so the point is, don't be discouraged. If you do call one bank and they say, oh, you have to have 40% down if you want to purchase something for 3 million, that's not the case across the board.
Unbelievable. Yeah, so a great time. I mean, so many people I think have been like really nervous about it. And believe it or not, if you are in the market, you get it. I mean, you'd be shocked. For us, we've been telling people we're only showing properties to pre-qualified buyers. They're being forced to send us pre-approval letters just to get in. So
Right.
something to think about. All right. So as we approach wrapping up here, I have a question for you that you're not going to like. So a lot of the banks have allowed people to forbear their mortgages.
Yes.
So forbearance, for everyone watching, basically says, we're going to let you not pay for, let's say, 6 months. There'll probably be an assessment 3 months in, as you said, to see if people can, to see if they can ultimately make it. But forbearance will allow people to, for a certain amount of time, not pay their mortgage payments. And then later on, that money will be due in full at a certain date. My question for you, as someone who's been in this for 2 decades, is forbearance a slow walk to foreclosure?
I hope not.
I knew you weren't going to like this.
This is I hope not.
And by the way, we're not going to hold you to it. I forgot to timestamp this video in the beginning. Today is May 27th. We're saying things based on what we know today, May 27th of 2020.
Listen, I worked through the recession last time. I think it was a different circumstance. This really does have more of a temporary feel to it. Though I know people are impacted so terribly. I don't want to say that make light of it. It's a terrible situation for a lot of people who have been off of work but it's different. I don't see the foreclosure. I don't see that happening again from this. I don't think that's going to happen. I do see guidelines tightening more in the future because of this. Forbearances are going to cause a problem. It's not going to be, hey, I just did a forbearance. I just skipped 6 months payments. I want to refinance in December. It's not going to be that easy. Freddie and Fannie just released some guidance on that. And to refinance in the future, they're saying that you can have had forbearance, but you have to bring that full amount to date with your own account, your own funds. You can't finance it into a new loan. So this is more for someone who has a home currently, of course. But if they wanted to refinance this fall and they did a forbearance over the summer, they can't just simply refinance and catch it up. They can't use the funds to catch it up. They would have to have their own funds, pay that mortgage up to date, then refinance. And, I think it's also going to lead to higher reserve requirements in the near future. So I think it's going to be a changing environment. It's just going to change all the time. So I'll try and keep you posted on the changes.
Sounds scary because if someone has, let's say someone's in entertainment, they buy a house for $2.5 million, the monthly nut is around $12,000 a month. And then they have to forbear 6 months of 12,000 is 72,000, I think. Yeah. So that's kind of a big number to get caught up on. Now, granted, people they probably have ways to tap their savings or whatever it may be to get brought up, especially because there was a reserve requirement from the beginning for rainy days. But it's an interesting thing, and it'll be interesting to see how things pan out in the next few months. So with 5 minutes remaining, I don't see another question, and I asked you mine. Is there anything else that you want to add before we let everyone go live their best lives?
No, I'm curious just on the real estate side of things. I love to hear what's going on your end. And you mentioned quickly earlier, you had 20 showings over the weekend, did you say?
Yeah, there's a website actually called Showing Time, believe it or not. And I frankly, I don't know how they track this stuff, but if you look at showings from kind of the 3rd week of March, at least in the state of California, and then up until this week, it literally went like this. And we're like way back up again to 2020. 2019 showings. It seems like in my market, if you look at all of my listings on Zillow, the views are like in the tens of thousands on some of them. And I think it's because a lot of people have just been home looking at their phones, looking on consumer-based sites. I have heard some crazy stories in my market of people stealing properties, but that's been at the higher end for sure, where the stakes are a bit higher for everyone involved. And I don't mean the real estate agents. I mean buyer seller or a trust,
Sure.
or something that's corporate owned by some special purpose entity. But I would say for people that are in the market now, they are expecting a little bit of something, specifically because things that are in the 2 million and below range, especially if they've been on the market for like even a month, there's this presumption because of the way our market's been, people haven't changed psychologically yet as far as their expectations go. They're like, something needs to sell right away. So if it hasn't, then it's ready for a discount. And I think because some people have their heads buried in the sand, still there's less buyer urgency, even in a low inventory market. So in some cases, and again, everything is case by case, a house with a monster view, you know, even if it's 2 bedrooms, is still going to perform better than the one across the street that does not. So it is case by case, but there are things happening where people are listing. I put something into escrow the 3rd week of March, and it was multiple offers and by the way, it was north of $2 million, and it went 250 over the asking price.
Wow.
And then there was one that I had that was north of 4 million, and that sold for like 250 less than the price. But
That makes sense.
full transparency, it was a relaunch of an expired listing. And while the owners weren't ready to reduce yet, that was my recommended reduction when we first met, even though they didn't agree to it on the agreement. So it sold for what seemed like fair market value. So, you know, I have something for almost 11 million coming on next week. This is also a listing that did not sell for way higher previously. And the owner said, you know what, I'd rather deal with the unknown that we know now than the unknown that we don't know later.
Yeah.
So he said, let's just go. So a lot of sellers, a measurable amount of them are not burying their heads in the sand because life change propels real estate change, and people, you know, deaths, births, school districts, downsizing, I guess upsizing, these things do not get paused because, you know, we're at home for a few weeks.
Right.
You know, people are still going through life change, and their lives evolve. And also the one other thing I'll say is that millennials have been really driving the real estate market nationally. They're the biggest group. They made up like 38% of buyers in 2019. They're larger than the baby boomers. And because of the 2008 financial crisis, they were forced to put a lot of life things on hold, like marriage, having kids, buying homes. And there's been all this pent up millennial demand, and they're now in the market. They're ready to be homeowners. So we've seen that really drive us and add stability to the real estate sector too.
That's awesome. I love to hear that. I have been hearing a lot about multiple offers, and all the buyers that I'm giving pre-approval letters to, they're like, we're up against another 15 offers. I'm like, wow, that's incredible. I guess it just shows how valuable our real estate is here. You know?
Yeah, here. And I think it's a device of pricing. I think the one thing that I've been warning sellers is just to be price sensitive more than ever. If you don't go for the aspirational number, if you don't have like an emotional house and an emotional site in an A++ neighborhood, because there's just less people in the game right now. Get near fair market value, you know, or price for multiples if you're in that asset class. Usually things don't go into multiples above a certain number. There's still, we're going to leave room for negotiation approach, but don't aim super high because it'll end up costing you money in the long run. Anyway, Lyndi, thank you for doing this.
Thank you so much for having me.
Thank Citi for being on call.
Office next door.
Had I known Citi was going to also be on, I would have added them to this, but I really enjoyed this. I will continue to refer clients to you.
Thank you so much.
Gifted at what you do. Do you want to quickly just kind of give an email address or something for people if they want to reach out to you after seeing this today?
Yes, thank you. That's great. Lyndi at lyndyforloans.com. That's LYNDI at lyndyforloans.com. And that's FOR spelled out, I should say. So LYNDI, Lyndi at lyndyforloans.com.
Awesome. And for me, you guys can see all my stuff because I had my marketing coordinator create these. You can follow me on Instagram and TikTok for really cool real estate tours as well as information. If you're an agent, always kind of loading in at least once a month and giving tips to newer agents. But we are trying to grow the YouTube channel, which this video is ultimately going to live on at youtube.com/Ben Belack. All of the same stuff. We sometimes tour homes that are $15 million, so it's a great place for that. Great entrepreneurial tips. And please, if you haven't done it already, you have to smash the like button. It helps give us placement on the YouTube algorithm. We'll do some more live webinars coming up. In the meantime, stay healthy, stay safe, and you can always call us for your real estate or mortgage finance needs. Thank you all.
Thanks, Ben.
Okay.
All right, we'll see you soon.
Bye, guys.